Last week we saw a classic ping-pong match between Donald Trump and China's Xi Jinping. Donald slammed a 10% tariff on the remaining untariffed $300 billion worth of Chinese goods, and Xi returned serve with a currency depreciation. It was his Robert De Niro play. You know, if you're gonna mess with me, well, I'm gonna mess with you. And the stock market did not like the Chinese top spin winner. Donald Trump's economic advisor, Larry Kudlow, returned with his top spin reply, saying more trade meetings will happen in September, which the market liked, but then Donald said he's not ready for a deal yet. And yet is the key word, as it says he does want a deal and undoubtedly thinks it will happen when he's happy with the deal itself and the timing of it. So let's just see what our 24/7 market players think about the chances of a deal and what it will mean for our investing and what stocks we want to invest in. Joining me is Julia Lee from her own fund management business, Burman Invest, and CMC's Michael McCarthy. Okay guys, you heard what I had to say. Do you think there's going to be a deal or no deal in the near future? And as a consequence, I'm going to ask you how you're going to invest. So Julia first.
Look, I don't think it's going to be in the near future, and I think the risks are big that perhaps we won't get a deal. I think if we get a deal from a political standpoint, it'll be closer to the November elections, the US presidential elections next year. But really what Trump doesn't want, President Trump doesn't want, is a recession going into this election, because, you know, that really decreases the chances of being re-elected.
So you're saying a deal could be well into 2020?
If it happens.
If it happens. Michael, what do you
I
think?
agree with that. The reality is the economics here are very clear. Everybody gets hurt economically in a trade war, and a resolution works for everybody. Unfortunately, the politics are going in directly the opposite direction. And it suits both President Xi and Trump to stand as staunch defenders of their nation's interests. And for that reason, I suspect this will be going on for a long, long time. Now, the good news from a market point of view is it probably becomes subject to the laws of diminishing returns. That is, after a while, investors will start to see the trade disputes as a nagging injury rather than a crippling injury. And I think that's the key takeaway here. This is not a market catastrophe in the making. We can never say never, and things could unfold badly. But this is not the credit crisis of 2008, and investors should see this as a drag on global growth rather than a threat to the markets.
And look, I don't think the issue is so much the trade war. We've been in this trade for over a year now. The issue is going to be whether or not we see the US going into recession. And I think that's the bigger question that markets are trying to grapple with. Well, my
thinking is this, okay, as I described as a ping pong match. Now, and Donald then came out and said his last shot was, I'm not ready for a deal yet. And to me, that makes me think he wants a deal, and it's going to be when it suits him, when the deal looks good and the timing looks good. But what if he said, okay, China comes back with a reverse play, and Donald doesn't like it, he says, okay, 25% on the last bit. Given what the market did on the currency reaction, do you think the market would have convulsions on a 25% tariff? Because, you know, China's not going to sit back and say, oh, okay, you win.
The market's forward-looking, so it's already started to price in the possibility of that scenario. I guess the problem becomes if China doesn't want to play and decides that it doesn't want to deal with President Trump, it's going to wait for those 2020 elections and deal with someone else. And look, I think that's a bigger problem for the markets than if China came to the table to deal. But I think for the time being, the market is starting to price in the scenario of a protracted trade war and is now looking at the possibility of a US recession.
But these are known unknowns. So whether or not, for example, tariffs are increased on September 1 is something the market is preparing for.
That's a 10% tariff.
Well, that's right. And it could go higher, of course. But so from a market point of view, the market reaction will tell us much more about the way investors are thinking than about the change to the fundamentals that might come with any measure. There were a number of occasions where announcements were made, they were clearly negative, they were an escalation of the trade dispute, and the share markets powered higher. The reaction last week showed us how fragile investor sentiment was, and I think that will be the value of these announcements and tweets and however we hear about the developments of the trade war, is that they'll tell us how investors are thinking and how they're positioned rather than changes in the fundamentals.
Okay, this might surprise the pair of you because you don't know me very well, but I tend to be optimistic. Have you ever noticed that?
No, I don't know.
Okay. Well, let me confess to you, I'm optimistic. And it seems to me that there is a belief in the market that a deal will happen, and that's why we haven't seen a serious sell-off. So you guys think I'm wrong, which is unusual that you think I'm wrong. But given the fact that you might be right, what is your view on where stocks go in the short term and then the medium term?
In the short term, the added volatility is great news for, I guess, those assets with limited supply. So things like airports or even gold is one way to play it. The other way is through the currency, the weaker Aussie dollar. So you're looking at those companies that are exporting a majority of goods.
Yep.
The healthcare sector as a whole is exposed in a positive way to a falling currency here in Australia, and it has been performing quite well. And then stocks like Amcor, Brambles and the like.
Safe ones.
Stable cash flows, but also highly exposed to that falling Australian dollar, which is what you want to see.
Michael?
Two things about strategy at the moment, Peter. First of all, continuing volatility. That is highly disruptive times in the market, followed by calms. And for me as an investor, and I would recommend a strategy, is take advantage of those low volatility times to create one-sided risk in the markets.
Explain what you mean by that.
By that, I mean, for example, a lot of investors are nervous, they're holding cash, and they get hurt if the market goes up. Well, you could take a small amount of your portfolio, invest it in call options, which will go up if the market goes up, and in that way you cover off on your market risk of underperformance. On the other hand, there are plenty of investors with large portfolios who don't want to sell them for capital gains tax reasons or any other reason, perhaps the dividend income's too attractive. They can protect those portfolios with puts. Now, the time to buy options...
But where can you buy these sorts of products?
On the Australian Stock Exchange.
Does CMC markets do things like this? Yes,
of course
they
we do.
But it's a good lesson.
But
yes.
you can buy them through any full service broker, any online broker. The reality is, though, those one-sided risk exposures can be very important if we get more disruption to the market. So that's a strategic imperative. I would argue, though, one of the key indicators of where the market's going is the sentiment. And so I'm monitoring sentiment very closely. And given the conservative positioning, the worries that are being expressed publicly, and by what we can see from our traders on the platform, it means the markets are actually more likely to rise than fall, in my view, in the near term.
Okay, but the thing that gets me is the market is not overreacting, apart from the odd things like China coming out and allowing devaluation to occur. That quite shocked the market, and the market reacted pretty violently until they saw, well, they're not really invoking a currency war, and they thought, okay, great. So it's like optimism is prevailing in the market rather than pessimism. But the talk from the bond market and the threat of a recession, if it became clear that Europe's going to be in a recession and America's growth performance starts coming off the boil in the last quarter, do you think the stock market would say, recession coming, this trade war is worse than what we expected, selling off?
Well, we've already had the signal from the bond market. We've seen that inversion of the curve. Now,
we're not trusting the bond market, are we?
Well, Peter, the bond market is a symptom of the current environment rather than a predictor of the future. And a lot of analysts...
People treat it as a predictor.
Well, they've jumped on the idea. This is what happened before 3 previous recessions. Yeah. We saw that big inversion in the bond curve. The bond curve is inverted. That means a recession. That's poor logic, Peter. The reality is monetary conditions have never been in the shape that they're in now. We've never seen the global monetary system flooded in the way it is at the moment. So while it is important to be aware of those things and aware of the risks, the fact that the bond curve is inverted has not increased the likelihood of recession.
So interest rates are going to keep things better than what I might be worried about because of what the bond market's saying and the threat of recession. You think interest rates will stop a recession?
While inflation remains low, and we get a lot of important inflation readings this week, I think that's a bigger danger to the market, Peter. Not a recession, but inflation saying an upswing, because that will limit the ability of central banks to respond, and then we could have a big problem.
And that's the problem, and that's one of the problems that the market is grappling with. Will we get stagflation, where we do see unemployment stubbornly high, but very low rates of growth and inflation rising higher? And in that type of scenario, it's very difficult for central banks to tackle that type of economic environment. And in that type of environment, the real assets do well, real assets and things like gold. So putting a little bit of the portfolio towards that.
But last time we saw stagflation, wage earners had power, didn't they? That was what was driving the inflation.
But the other thing also to have a look at is that there are very limited ways to get returns at the moment. You've got negative real interest rates in most of the globe at the moment. So there's a whole pile of cash that's looking for a home. And sometimes these pullbacks are just an opportunity to get in, and then you see that wave of momentum come through once again.
That's the big stuff we're talking about. Let's talk the money-making stuff now. All right, iron ore prices on the way down. Is this because Vale is now producing better than it was before?
Yeah, whenever it comes to commodities, generally the rule of thumb is the time to look at selling is when you see a supply response coming to the market. When you saw iron ore at 120 US a tonne and Vale talking about bringing back supply on in Brazil, well, that's a pretty major signal for the iron ore market. Coupled together with the lower rates of growth in some of the indicators we are seeing globally, as well as the inventory levels that we are seeing for iron ore as well as steel out of China. And you've seen iron ore prices down more than 20% now over the past month.
So do we sell BHP and Rio now?
I think it is time to take a bit of money off the table. And look, you've done very well out of companies like that.
Yeah, Michael?
Yeah, well, it is partly Vale, but the key to this market remains Chinese buying. The reality was they had record imports of iron ore in June and July. And while that's the case, there is an underpinning to the market. I think the sell-off we've seen reflects a flip around in market mentality. And as Julia mentioned before, markets price the future. So they're pricing that future supply coming on. But if China makes a demand response, all of that could be negated. And of course, that's assuming that Vale will be able to get going.
Answer the question. Highbrow answer.
Do we
sell or buy on?
Hang on. I'm not adding to supplies, but I'm not selling.
Because Rio is dangling a dividend as well.
Well, I sold out of Rio on the way up at 97, so I missed out on the top at 108. So I've already reduced exposures, but I'm hanging on to my BHP.
Okay, right. Let's go to gold. If you guys are right, and I hope you're not, you should hang on to gold, because if there's no deal, gold's going to look more and more attractive.
Well, gold has been doing well. I mean, if we have a look at the gold ETF, which is Australian dollar gold, it looks pretty, but it's up 10% over the past month compared to gold in US dollar terms, which is up around 6 to 7%.
Yeah.
But the gold miners are up by 20% over the past month already.
Okay.
So you've already seen that response come through. I think you'll continue to see strength as long as the volatility persists in terms of the market.
There's a ceiling at 15.25. I'd like to see it break that for it to go higher. I suspect we're looking at a pullback somewhere to around the 14.30 level in the short term.
Okay, is Newcrest the company to buy?
Anything with costs in Australian dollars and selling gold in US dollar terms is a beautiful scenario at the moment. Or you can just buy the gold subsector, XGD.
JB Hi-Fi reported today. The shorters always keep telling us it's a bad stock. It proves a lot better.
Incredible result.
Yeah.
Look, the strength in JB Hi-Fi, I think, is phenomenal, especially given the backdrop of those weakening house prices that we saw in the period that it reported. But more importantly, the market's usually concerned with the latest numbers that we get. So the latest sort of into the looking glass that we got for the July numbers. And in those numbers, JB Hi-Fi, like-for-like sales in Australia, up more than 3%. But the good guys down more than 3%. And I think that tells a story where the strength is in the electronics, the computer side, and the household appliances not doing so well.
The housing sector is pretty good. Mike?
7% profit increase. That's good enough for me. 31.60, an all-time high in trading today. I suspect the shorts are in a world of pain.
Two companies, and you guys are in there, two companies worth buying as soon as the market hates them is JB Hi-Fi and ResMed. And they always come out and prove them wrong, don't they? It's unbelievable. Anyway, REA hits an all-time high, about $102 or something today.
104.28 actually. Yeah.
This is a company that defies its critics. Though there aren't many critics. Everyone seems to like REA.
Yeah, REA and Domain did well today as well. And I think what we have seen is a stabilisation in house prices. The next step, I think, for the next step up in the share price is that we see volumes in terms of listings coming back, because we're still seeing pretty low listings in terms of the market. But if we can see those two things, I think it's quite interesting watching REA and Domain. If we continue to see that sort of trend and then the volume coming back, you are going to see an uplift in some of those retailers which are more exposed to those domestic housing type of trends.
Too late to buy REA, Mike?
Well, it makes me think of CSL at $100. A lot of people thought that was too late, including me. At 220, I was looking pretty silly.
I know. Okay, all right, last one I was talking about, before I ask you what you like, Star It's hit a one-year low, down 13.5% since mid-July or late July. What do you reckon? Is Star a buy at these levels, Julia?
I don't think so. I think the spotlight is on the gaming space at the moment, given that Crown's been in the news quite a lot. So look, I think that points to more regulatory pressure, which probably makes it a more difficult environment for both Crown and Star.
I'm having a good look at Star at the moment. I think today's selling related to a planning consent that wasn't approved. However, long term, I think that the competition provided by Crown to Star has been overblown. They're aiming at different market segments altogether. In fact, there's talk there'll be limits on entry into the Crown Casino for high net worths only. So if that is the case, then the competition aspect has been vastly overblown. It's on a well below market multiple. I think it's worth a look.
Okay, let's get to your favourite stocks. Julia?
I think given the environment at the moment, I'd have to go for something that was exposed to the falling interest rate market. And look, while Sydney Airports looks expensive, Auckland Airports in comparison doesn't look as expensive. So AIA is the stock.
Even after they lost to rugby on Saturday night, you're going for a Kiwi. There'll be plenty of people flying into Auckland Airport next Saturday for the big return game. Okay, Mike.
Reliance Worldwide. Its shark bite technology, I think, is world beating. They're not the only ones in the space, but they're the leaders. They've got a good push into the US. There's concerns about their UK operations, and that's fair enough. But having fallen from above $6 a share to closer to $3, I think it should be,
it's been a good company in the past, hasn't it?
Absolutely has.
Guys, thanks for joining us on the program.
Pleasure.
Thanks, Peter.
That's Michael McCarthy from CNC Markets and Julia Lee from Burman Invest. Well, welcome back, and I've got my colleague Paul Rickard from the Switzer Report, and Paul, of course, was the founding CEO of CommSec and was, I believe, stockbroker of the year.
Yeah, it was stockbroker year. Thanks for the intro, Peter.
Yeah, well, just show you got some credibility here when it comes to me. And I actually said to him, give us 3 stocks that you like, given the trade situation, as he says. And I've talked to Michael and Julia about the same thing. What do you think about the trade? These guys think it could stretch right out into well into 2020.
Well, I think on the one hand, Peter, you've got the argument that Trump needs it before the election. The other, you've got the question about the Chinese saying, well, we're in no real hurry here. We can play the long game here.
We can stimulate.
Yeah, we know the America's got an election in November next year. We can stimulate anyhow. So I don't think the Chinese are going to be in a hurry to give in on this matter. I don't think they can afford to give in. So I'm probably of the view that it'll go a bit longer, Peter. But
okay.
You know, I think Trump would like to move on to something else too. I think that's the other concern for him.
Yeah, that's a good point. All right, so given the fact I put you on the pressure, I said give us 3 stocks that you think are well positioned for this unusual investing environment we're in. What are they?
Well, a couple of defensives. The first one reported today, JB Hi-Fi, Peter, which the market hasn't liked the retailing segment, right? We've had so many headwinds, not just because we've got fairly anemic sales growth, we've got low consumer confidence, we've got deflation because of the disruption.
And Amazon's coming.
We've got the online threat, we've got Amazon, all the rest of it. Look, they reported pretty strongly today. I mean, profit up 7.4%. on the sales growth of 3.5%. They actually exceeded guidance, their guidance around net profit.
They generally do, don't they?
They generally do. I mean, I looked at all the sort of the metrics you judge a company by. Profit grows each year, earnings per share grows each year, dividend goes each year. They're good at controlling their margin. Sales growth, they've got top line growth. They've got a superb management team led by Richard Murray. Yeah. The only problem seems to be they're a retailer, right? And every other sort of question about what makes a great stock, low gearing, strong balance sheet, a good cash flow.
And when you go into a store, there's lots of people.
There's lots of people, and they've been able to reinvent themselves in terms of the categories they're in. Now, I think strategically they perhaps made a bit of a mistake buying the Good Guys business 2 or 3 years ago. They've turned that now into very much an appliance business, and so that's the place you go to buy for refrigerators and those type of things. They had a bit of sales growth there, but most importantly, they actually got more money out of it. They've actually been able to increase their prices and improve margins. So although there's low sales growth, they actually became a lot more profitable. So I think you've got to say they're a pretty strong team. Now, the negatives seem to be they're a retailer and the market gets short. The market still has big short positions, 4.8% dividend yield. So, look, you may not buy it today because it's rallied 10%. But no.
But it's unusual. They often sell off when it does well.
It is. And I think that's probably some short position covering. But it's a stock to buy. I don't think the shorts will go away in the medium term. Well, so you buy back into it the next time the market marks it down.
I said to Michael and Julia that two stocks that often get criticised along the way is JB Hi-Fi and ResMed, and they always outperform when they actually do the reporting. Let's go to your second stock, Paul.
Well, look, I'm actually going to put Transurban in here. Now, I have been a critic and said it's got too expensive.
You love the company.
But look, I do like the company. I think because interest rates are now so low and look like they're staying so low for such a long time, irrespective of what happens with the trade war, look, I think you've still perhaps, again, shareholders or small shareholders will get a chance to buy shares in the share purchase plan coming at $14.70. That's where the institutions paid last week. You'll be able to get up to $15,000. They're trading today about $15.15. I think you follow your institutional friends on that and you just back the stock.
So what kind of yield would you get?
It's not super attractive. They're going to pay 62-cent guidance dividend next year, only about 10% franking in that. So the yield is in the low fours, very low fours.
But it's still better than term deposits.
But it's still better than term deposits. Probably pretty safe. Interest rates aren't going up. I think there's the risk with Transurban, Peter, is perhaps that the end of the growth period has come. That is that the number of motorists using tolls is just not going to grow the way it has, and certainly the heavy vehicle switches, which has been one of the reasons why they've done really well. That is more heavy vehicles. They pay a lot higher tolls than do passenger cars. So a lot of the growth has come through that. So their toll revenue for the year was up by over 10%. I think that's unlikely to continue. So getting used to increasing distribution, I think, is perhaps going to be more challenging. But look, still pretty safe, and it's hard to go past because I can't. There's not really a lot grabbing me. And
you're not giving us high risk stocks. You're giving us good risk stocks.
I think I'm giving you fairly low risk stocks. Yeah.
Okay, let's get your third one now.
Well, I'm actually going to put the major banks in this category.
I thought you might.
And I tried to think through what's going to happen with the trade war, and I can't see them being too impacted either way. If the trade war, really gets worse, okay, they're going to sell off like the rest of the market, right? But
interest rates go low, is not good.
Interest rates go low is going to be a negative, but then again, it's also going to be. There's not going to be. It means the yields they're offering are going to come so damn attractive.
Correct.
So if interest rates do go to zero here, or we get to negative interest rates, and I don't believe it, but let's assume that the trade war continues and everything looks pretty horrific out there. Okay, they're going to get squeezed on margin, but they're currently their yields are going to look very attractive compared to 0% interest rates.
Okay.
Right? So it's sort of hard to see them being. I think they're pretty much a market neutral stock. They'll go down in a trade war. Trade war doesn't happen. They'll also benefit because the market will go up. And
if you buy them now and things come good over the next 2 or 3 years and growth returns, interest rates creeping up, you're buying banks at a good price.
Yeah, and look, and I think they are. I'm not saying they're turning the corner yet because I think there's a lot more work to do on the cost side. But Bendigo reported today that was better than expected. I thought the CBA result was a bit weak last week. They need Matt Common needs to really get the razor out and get the razor gang in at work. And
He mentored Matt Common when he was young. All right, now, so what's the one you like now? What's the bank now?
Well, I'm probably going to go Westpac. It's the hardest of the three majors to read because they say the least. Right?
Hudson gets away with that,
He
doesn't he?
does get away with it, and he keeps. I mean, look, I think the NAB. Look, yes, when Ross McEwen gets in there, but that's a long way away from happening, right?
I checked their yield out today. It's about 6%, Paul, before franking.
But it has gone up in expectation,
Yeah.
and you know when a new CEO comes in, I'm sure that there'll be a lot of change and that's going to be a bit disruptive. So the new CEO effect tends to be, okay, it's great when new CEOs get announced, but when new CEOs take over, they tend to take a little while to actually demonstrate what they can do. So, and the ANZ,
he's an aggressive kind of guy.
He's an aggressive type of guy, but I think we're 12 months away from, at least 18 months away.
Okay.
ANZ come off out of favour. I think they've just have a few challenges with New Zealand at the moment, and they've got to get through that capital issue in New Zealand. So I'm going for Westpac. It's the quietest of the majors and the hardest to read. But
well, I'll go.
I think it's because they're a relative underperformer, so maybe there's more upside there.
Okay, and I'll go for NAB. I think 6% yield, even if they cut, well, they've already cut the dividend in anyhow.
They've already cut their dividend.
Yeah.
I think the dividend on NAB is now secure. Westpac's probably got to cut it a little bit.
Yeah.
And that's probably the risk, but I think that's sort of priced in. So, but I look at the sort of the Westpac NAB sort of what I call the price gap, and there's a great relationship between Westpac and National Australia Bank.
Explain it quickly.
Over many years, Westpac is typically ranges between $2 higher to flat. Right?
Yeah.
Whenever it gets to flat, it never lasts. Right? It's currently NAB has come up because of the Ross McEwen effect.
Yeah.
Westpac's looking a little bit cheaper, so there's not a lot in the field. I think you can buy anyone, I think, in this market.
I must admit, I do like NAB's new ads. They're so inspirational for business. For their sake, I hope it works. That's Paul Rickard talking about his favourite three stocks at the moment, given all the trade concerns out there. Coming up, I'll be talking to Mike Gable. And I've asked him to look at the key charts that tell us where this market might be going in the short term and the longer term. And he looks at three stocks, CBA, Blackmores, and finally he looks at Afterpay, that very trendy, high-powered stock. Coming up after the break. Well, at the moment with the Trump-China ping-pong match going on, one thing I have is reservations about how you play the stock market in the short term while the game is going on. And so, even though I might have a value judgment that I do believe that Trump will eventually chase some kind of a trade deal before he gets into the election campaign in 2020, I want to know what the charts are saying as an additional insight to what might happen to stocks going forward. And the guy I go to when I want to know about charts is Michael Gable from Fairmont Equities. Mike, thanks for joining us.
Thanks, Peter.
Okay, so just generally speaking, what is your take on this, as I described it, the ping-pong match between China and Trump when it comes to tariffs and now currency?
Yeah, I think it's important, Peter, to break it down into a shorter term and a longer term view.
Yep.
So longer term, we're still positive on the share market. We have been so since the end of last year. In an environment where rates are going down, that's good for share markets. But like the end of last year, we have this fear that something further might happen because of trade tensions. But the important thing to remember is last year, everyone thought the US would be raising rates. Now we know that they'll be cutting rates, so that's the positive. So positive longer term. Shorter term, however, I'm quite cautious on the market.
Okay, so let's go and start with the Asx200 Index. I've asked you to look at a number of, I think, bellwether stocks in some regards. But let's go to the Asx200 Index to see what the charts are telling you.
Yeah, so at the moment with the Asx200, it does look quite negative. So one of the main indicators that we're using for our market as well as the US is a 50-day weighted moving average. So on the chart,
which
you
is
can
the blue line, is
it?
it?
The squiggly blue line that's following the market up. And as you could see, since the beginning of the year, our market has been above that blue line, meaning we're trending higher. Apart from a few occasions where it really, I guess, briefly flirted with breaking it, it's generally stuck to the upside.
Yep.
The difference this time, as you could see, top right-hand corner, massive drop through that line.
Yep.
Now, it's very unusual for markets to suffer a fall like this and then just continue on as if nothing happened.
Rebound and get above it again.
Yeah, exactly.
Yeah.
So It'd be different if this fall happened after we'd already decreased a certain amount, but coming at the top of a trend. Most likely we should expect a period of consolidation.
And to contrast that, you can see that we were below the 50-day moving average around December, but we've been down for a long time. So when it got above, it was a believable jump above, and you believe. But you're saying the opposite's the case here.
That's correct. So what we might get is a bit of a retest of the line underneath.
Yep.
So as we can see on that chart, a couple of big days down last week, Monday, Tuesday. Sure, we had a bit of a rebound at the end of last week, but it was a fairly feeble rebound. So our market needs to consolidate. We might head sideways for a while, or we might head further south. So what I've put up on the chart is a couple of horizontal lines showing levels of support. We could see there's one near 6,300. At worst, we're down near about 6,100. But like anything in this market, when fear takes over, who knows where we'll end up.
Yeah.
But at the end of the day, I think you should expect some short-term downside. The way I've been tackling this for clients is, we've dumped a lot of our high beta stocks with high volatility, stocks with links to China, and just staying a little bit defensive until things start to tick up again.
Okay, so let's go when we're talking about a defensive play, and I guess banks haven't historically been seen as a defensive play, but the income levels are so good. Let's have a look at CBA. What are you seeing there?
CBA, this $77, $78 level, when you look at very long-term charts, is a very strong support level. So I'm not surprised that it bounced off that last week. However, CBA will go ex-div fairly shortly in the next couple of days. So that'll bring the share price back. And I think if the market comes back, unfortunately, CBA will come back as well. If you're a fund manager selling the market, you're selling CBA. So I can see downside in CBA, potentially to about $75. But I think below that, you'll see a decent amount of buy come in.
That's right, it's $75 or lower, definitely. Okay, so that's the position. And of course, it's going to have a big impact on the index as well.
Yep.
Let's go to the next one, mate. That would be Afterpay.
Yeah, so Afterpay, very popular stock out there. I guess there are a lot of retail investors still thinking, okay, we're getting a dip. Now's the time to buy one of these stocks that I've missed out on buying for too long.
I suggested at $11, but we're not going to see $11 for some time.
Probably not, not. But I still think we'll see cheaper levels. So what I'm trying to indicate with this particular chart is the fact that Afterpay has been fairly range-bound since its peak in May. The diagonal line at the top, the blue line at the top, that's showing us that the next couple of peaks have been lower. So we're seeing lower highs, which means every time Afterpay tries to get up, people are hitting the sell button. So at the moment, it's in the middle of its current range. I'd be looking for lower levels or a clear break to the upside. Unfortunately, it's in no man's land, and every time it gets to the high 20s, someone hits the sell button.
Do you like the company?
They're doing really well. That's for sure. But if I had to make money in that space, my bet would be on a recovery in Flexi Group.
Really?
Yeah.
That's a speculator.
Yeah.
They've got a new name now, haven't they, Flexi Group? Hum.
Yeah,
that's
right.
right.
It's called a Hum.
And I guess one last question is, at what level do you think Afterpay would be a screaming buy for you?
I think the first level is, as we can see on the chart, there's support near $22. It's not that far away. But the way it's trading, I wouldn't be surprised if that does get breached. So I think anything under 20 is where a lot of people start to
get excited.
Yeah.
Okay, let's go to the next one now. Now Blackmores. Now Blackmores was a company that has absolutely shot the lights out, particularly under Christine Holgate's leadership. And of course China was more supportive in those days. Got well over $200. Then it fell. I know on my TV show I said, if this gets around 92, I expect a bounce. And we saw that happen last time around. But this time it's gone lower.
Yeah.
So what is the chart telling you now?
Okay, this one's very interesting. So if you're into Blackmores, keep an eye on it for the next few days. And the reason why I say this is, as we could see since February, it's been trading in a range. So this sideways range.
That's an unusual chart. I've
It
seen
is very
many like that
unusual, very unusual.
in my life, really.
But if you follow charts, what gets you excited is when you see a stock stuck in a range, because when it gets out of that range, you get a powerful move. And the
Right.
longer it's in that range, the more powerful the move when it does break out.
Yeah.
Unfortunately, Blackmores is showing us a break to the downside, which means we could get an acceleration to the downside. However, and this is why these things aren't always easy, sometimes you get false breaks. So Blackmores has broken to the downside. If it quickly recovers and gets back into that range, then it's telling us that there's been a lot of buyers waiting on the sidelines and have bought up the stock. And if it gets back into that range, you'll see it accelerate sharply to the upside. However, if in the next few days it can't make any progress to the upside, then it's a downside break and we should expect lower levels.
Yeah, Mike, one of the things that I like to do when I'm following a stock that, I might call it a speculative stock, which I think Blackmores would be in my portfolio, is I like to see when you get this kind of bouncing along the bottom and then a kick up. And I don't care if I miss the first 5 or even 7%, that usually makes me think the bottom has been created and it's now on the upswing. Is that a fair general way to look at stocks?
Yeah, definitely, because you can try to get in early. So if we have a look at Blackmores, you could have tried to have got in the last few months and it would have done nothing for you while the rest of the market went higher. So there's definitely a case for waiting for confirmation of a move, and then you miss the first 5% or whatever it is, but you then have a lower risk entry point.
Now, when you get a company like this, do you then look at the fundamentals and other things, or do you just stick to your charts? Are you a charts guy only?
No, we do both. So we look at the fundamentals as well. Often I'll see a stock where the chart looks fantastic and I'm thinking, I wonder what's going on here. And that'll lead me to investigate it further. So FlexiGroup's an example where it did something really interesting at the beginning of the year. We had a look into what was going on, and then we decided this looks like a great turnaround story, and it's actually done pretty well. But when it comes to managing our risk with the trade ongoing, then we continue to look at the technicals. So if something is telling us, look, this share price is breaking down, even though we haven't heard anything from the company, nothing's changed, we're probably best to get out before.
And for those, and people who don't really understand, the hocus pocus for people like you, what in a sense you're saying is that the market can give you signals about the consensus, whether a stock is liked or disliked, isn't it? And so what we're seeing here, it's not quite certain about whether Blackmores is liked. Until it dropped below that line, you probably would have thought it's close to being liked again. We don't know, but when they're on the upswing, it indicates to you that there are more likers than haters.
Yeah, that's right. As I said, if we determine that this is a false break in Blackmores, meaning that it gets back up above $90 and starts to rally, then that's telling us that there was a lot of serious money on the sidelines waiting to get back into Blackmores, and now they've shown their hand. So we'll see in the next few days if that's the case, but that's one of the great things about the charts.
Okay, you gave us FlexiGroup, and that was within the context of a group which you might have Afterpay, Zip Money, and all the other ones that are in that space. Is there a stock that you maybe found last week you thought, gee, this is looking very promising?
Unfortunately, at the moment, we're not really buying anything while the market looks really weak. So we're tending to hold on to some of our core stocks, gold stocks. But an example of a core stock would be Sydney Airport. So I'm happy to stay long stocks which are interest rate sensitive. So as interest rates go up, these stocks look more attractive. And when I mentioned earlier about stocks that trade in a range for a long period of time, when they break out, you get a powerful move. Sydney Airport, up until probably several weeks ago, was stuck in a range for about 2.5 years. It just couldn't get above, I can't remember the numbers, I think it was $7.50 or something like that. And then it broke out, came back a bit, and now it's on the move again. So I wouldn't be surprised if Sydney Airport heads to levels over $10 over the next few months, simply because there was a lot of selling every time it went up towards these levels, and then it finally got through, and now the other buyers are showing their hands and they're picking it up.
It's a pretty defensive play too, isn't
and it's
it?
defensive as well.
Mike Gable, thanks for joining us.
Thanks, Peter.
That's Mike Gable from Fairmont Equities. Tim, thanks for joining us.
Great to be here.
Now, one thing that I've been doing out in the media is saying that we're a chance for a second half economic rebound. And I'm really hoping the Reserve Bank doesn't have to cut interest rates on Cup Day, like a lot of my economists are saying. So surveying someone like you who's watching small business all the time, is it a forlorn hope to think that things are getting better?
No, I don't think so. I'm cautiously optimistic about what the second half will bring. If we put on the economy-wide side, there's lots of things that are happening, right? The tax cuts will get through to people's back pockets. Yeah. Iron ore prices remain high. You know, there's good impetus around the economy overall. When we look at small business, you know, going into the election, I'd say things were fairly downbeat. Yeah. Like there was a lot of nervousness, a lot of concern over what might come from the election. With the Morrison government re-elected, you look at this government, they have lowered tax rates for small business from 30 to 25%. They increased the instant asset write-off up to $25,000. They made it applicable for businesses from 2 million up to 10 million, so a lot more businesses fell in there. And they created the Australian Business Securitisation Fund to hopefully get more competition into lending to small business. So this is a government who's got a good track record for small business. I think small businesses are still a bit cautious right now. All of the evidence that I've seen coming out is it's almost a wait and see sort of pattern that we're in at the moment. But I think through the second half we'll see that thaw and we'll start to see the economy pick up a bit.
Explain to my viewers about this securitisation and the fact that it's going to try and make lending better for small business.
Yeah, so look, the government recognised that there is a lack of competition in lending to small business. And you know, the big four banks really got out of lending to small business a couple of decades ago.
Crazy.
Right? And the only reason they'll lend to most small business owners is if they use their mortgage as security, and that's not really a small business loan, that's a mortgage. Yeah. And since they've done that, I think they've actually lost some of the capability to lend to small business. And what we're seeing elsewhere in the world is new organisations start to develop and come through who are targeting just that, lending to small business. Part of the challenge for them, though, is getting enough credit behind them to be able to lend it to the small business. So the government did a very sensible thing, I think, which was to create the Australian Business Securitisation Fund, which is a fund that new businesses that are starting lending to small businesses can apply to be a part of. It can't be their only source of funding. They've got to have some equity investors. They've got to have some debt coming in from elsewhere. But it will help them speed up and be able to get traction more quickly.
And how much money is in this, do you know?
There's a couple of $2 billion that's been put aside in the first tranche, and you know, if that is well invested, then hopefully the government will keep going forward from there.
And I presume it must be at a reasonable rate of interest, and the government's going to, I guess, watch what rates they charge small business as well? Yeah,
so the government isn't regulating the rates at which the participants in the fund then lend to small business. I think they're trying to create a competitive market, which means there'll be lots of different offers out there. But the government are lending to those organisations at a reasonable rate, so that should allow them to pass that on to their customers.
Okay, the increase in the minimum wage, has that hurt a lot of small businesses, or is it sort of depending on what sector you're in?
Well, not nearly as much as the living wage would have.
Let's just that was Bill Shorten's living wage, yes. That was quite a substantial rise, wasn't it?
Look, the increase in the minimum wage always hurts some small businesses because it is small businesses that generally pay the awards. You know, lots of larger businesses have enterprise bargaining agreements, and therefore an increase in the minimum wage doesn't flow directly through to them. But it will always hurt some small businesses. On the other hand, as a community and as a society, we need to make sure that the living standards of those who are earning just the minimum wage don't fall too far behind. So it's always a balance. I haven't heard any more noise this time around in particular than
And the bottom line is the people who get minimum wage rises are big spenders, so it should help retail.
Correct. It does flow back into the system.
Okay, you do a lot of surveys, and what is that What are you seeing from those surveys, from the sector and also your own business?
Yeah, absolutely. And look, 1.2 million customers, we survey them regularly, we reach out, we do focus groups, etc., trying to understand what's on their mind, where their priorities are.
A business understanding customers, that's a rare thought.
Yeah, trying to. Look, I would characterise it, there are times when we go out and do that research and it's all gung-ho, like everything's up and everything's firing and it's all about winning new customers, entering new markets. There are times, and fortunately not that often, where it's about cost control and management, batten down the hatches, Right now we're somewhere in the middle. So the priorities that small businesses are looking at is 1, creating new products and services, 2, customer retention strategies, and 3, around focusing on margins and profitability. And that says to me that business owners that are out there, they're thinking, they're proactive, their mind space is quite positive. We're not quite in those heydays of
gangbusters,
everything's going right. But there's there is a real focus on business improvement and how do I create growth in this environment.
Because Tim, the NAB survey surprised me on one level that business confidence actually dropped, but business conditions, which tells you what business is saying about business right now, actually went up. So it's like things are okay, but we want to believe that the future is good, but at the moment we don't.
And that surprised me as well. I was actually expecting, because I think it was at 6 points and it dropped down to 2. I was expecting it to, and 6 is sort of the average. I thought we're going to start entering above average territory. So, surveys are surveys, and you want to look at the trends, not just those one results.
A lot of normal people who don't employ people wouldn't know about single touch payroll.
Yes.
But quickly tell us what it is, and tell us if you think it basically is going to be a good thing or a non-relevant thing to the business.
So single touch payroll is a piece of legislation that the government has passed that requires employers to report payroll information of their employees to the ATO every time they do a pay run, rather than waiting to the end of the year when they used to create payment summaries and report it to the ATO at that time. It should be a good thing for small businesses because now it's just a part of the natural process of doing a pay run. So MYOB, we've built into our software every time you do a pay run, you can just turn on the ability that gets sent to the ATO. Business owners don't have to worry if they make a mistake, that mistake's been reported to the ATO, because that just gets corrected in the next pay run. So they've built in a great mechanism for business owners to be able to have confidence that that they're not going to be caught out, but B, they don't at the end of the year have to go through that grueling end of year process of doing all of those payment summaries and reporting that information.
And there
to
could
the
be
ATO.
a major problem that you've been doing for a year, which could be a really hard thing to make up in terms of cash flow.
Right. So it should be a good thing for small businesses. We have turned it on across all of our payroll offerings. We've actually launched a new $10 per month payroll only product for businesses of 1, 2, 3 or 4 employees, just to make it affordable for smaller businesses to really comply.
And do you think it's going to help the government keep an eye on employers who aren't paying their super?
It will. It absolutely will. And the other thing it will do is allow the government to match that information with the welfare payments to make sure that people aren't claiming payments that they aren't due. So all round, it's a good outcome.
Okay, Tim. Now, one thing we're doing on the new Switzer program is actually sending this to the Prime Minister and the Treasurer. I taught the Prime Minister, so I don't mind giving him a lesson. Is there anything you'd like to, I haven't told you guys, this is good, but is there anything you'd like to directly, and I know you talk to them anyway, but is there anything that you think is really important that both the Prime Minister and the Treasurer could get behind to help small business?
Yeah, absolutely. Look, there are 2 things. One, continuing to work to remove red tape, and there is lots and lots of it. And the government has been attempting to do that.
We'll give them 3 years to do a decent job.
There you go. But 2, just like single touch payroll will make it much easier to run business in this country, the big one out there would be e-invoicing. So we can get behind e-invoicing as a nation. It will mean that small businesses are paid on time from big businesses and from governments. It will lower the cost and the time that it takes to do the accounting, lower the time it takes to do reconciliations to the bank and all those things. So
Are there any barriers to that, or is it just an education thing?
No, well, we need to get the infrastructure in place, which this government has committed to.
Yeah.
And then we need to have government leading and ultimately I think it should be legislated.
Okay.
That that's how we do business in
Well, follow
Australia.
up with more information to me. I'll write some stuff on it as well, and I'll also, shake the windows around all the walls on this one as well.
Excellent.
All right, mate. Great
Great.
to see you.
Peter, good
Tim
to
Reid?
see you. Thank you.
Tim Reid, CEO of MYOB. And finally, if you've enjoyed the Switzer TV experience, please hit the like button and subscribe to our YouTube channel. I'm Peter Switzer. Thanks for joining us. See you next week.